Is the impact of US news on cryptocurrency decreasing? If you're interested in knowing more about this, please keep watching. Bybit is one of the best exchanges I've ever used. It provides great market depth, a smooth user experience, and an impeccable interface. Now, complete KYC and deposit $100, and you'll receive $30 in trial funds. This is a really great deal. The promotion is only valid until May 14th. Act fast. Spots are limited. Now, let's talk about the CPI. If we observe the trend of CPI in the past, we can find a small pattern. Let's compare the predicted and actual CPIs for each occurrence and compare them to the previous ones. We also take into account the rise and fall range of a single 4-hour candlestick. Actually, we can slowly compile statistics on how CPI affects the market and what its trend looks like. All right, we will see. That last time, the predicted CPI was 5.0. The actual CPI was 4.9. It's certainly a short-term bullish signal. There's no problem with an upward trend. We can measure the size of this increase and its impact on the market volatility. It's 2.4%, which is not significant. Within 4 hours, you might ask why we're not considering the subsequent decline. We're only focused on the 1 4-hour candlestick. The CPI was announced at 8:30 a.m., so we're focused on the 4-hour candlestick. That starts from 8 a.m. to noon. We discuss it based on that. We don't discuss the subsequent 4-hour candlesticks because they have little to do with news. News must be reflected in the market immediately. That's what we call the power of news. News is like the moon, sometimes full and sometimes half. That's its nature. Let's look at our previous CPI. It was predicted to be 5.2, but it turned out to be 5, which was still good news. But the market didn't go up. Instead, there was a doji candlestick on the 4-hour chart at that time. A doji with a price change of 2.66%. Let's go back to March 14th. We predicted 6 last time, and the actual CPI was 6. But the market didn't move much. The change was only 1.66%. Almost no price change. As you can see, the price volatility in these periods was very small. Let's look at the time before that, which is February 14th. It was actually bearish news. The news was supposed to be bearish, as the actual CPI was higher than the predicted CPI, indicating a more severe inflation situation. Undoubtedly, it was bearish news. But the market rose by 3.4%. Surprisingly, the price went up. It rose. The price change is 3.4%. It's not a big change. If we compare this to previous times, when we saw large price fluctuations of 8 to 10%, a 3.4% increase or below is not significant. Let's go back to an even earlier time, January 12th. We had a prediction that matched the actual CPI. It met expectations. So what was the price fluctuation? It was slightly above 2%. It's very small. Let's go to December 13th last year. The actual CPI was lower than the predicted CPI. That's a bullish signal. Price went up due to bullish sentiment. No issues. But it closed with a long upper shadow. The price fluctuation was around 4%. As you can see, the prices have been hovering around 2 to 3% volatility when the CPIs were announced. Let's look at the earlier market trends. Much earlier. The forecast, 8. The actual, 7.7. Bullish news. Price increased. What was the increase percentage? It went up by 10%. It's a 10% at one go. And what about the time before that? Oh, this one was slightly smaller. But you can see that the fluctuation was still significant due to the shadow of this candlestick. The price change was almost 5%, 10%, 5%. What about the time before that? Wow, this one was even more extreme. It was more extreme. The price change was over 8%. All right. After reviewing all of these candlesticks, we can see that the impact of CPI on the market has been decreasing over time. Previously, 8% or 10% price movements were not uncommon. But now, it's only around 3% or 4%, and sometimes even as low as 2%. Therefore, the influence of CPI on the market is diminishing, and it's becoming more unpredictable. You see, in the past, if the actual CPI was higher than the predicted CPI, which was a bearish signal, prices would drop. It's reasonable. Here, the actual CPI was higher than the predicted CPI. The price was supposed to drop, but it gave a long lower shadow. And here, when the actual CPI was lower than the forecast, the price surged. So in the past, the relationship between market movement and CPI followed the rules of the news. However, it has become more unpredictable recently. It went up here, right? Yes, it went up. Right after the CPI announcement. Of course, these are all bullish signals. Then, the CPI forecast matched the actual figures, yet prices rose. The price did rise. The price went up after that. But the forecast and actual CPIs were the same. And then, this is the most special case, where it should have been negative. But a sudden surge occurred. Here, the price increased, right? And here, the price rose after a doji. Here, another surge. Basically, we can summarize a rule based on our analysis of several CPIs. The impact of CPI on the market, especially in terms of price volatility, is decreasing. Also, every time the CPI is announced, the price tends to go up. You can review the market. However, I personally don't trade based on CPI because I'm not a news trader. However, we're still able to get this pattern. Let's look at the other event that goes hand in hand with it, which is the Fed's interest rate meetings, also known as the FOMC. As for the FOMC, judging from the market review, the predictions are almost always accurate and rarely deviate from the actual interest rate. Rarely. After the FOMC announcement, the market typically experiences the most movement within the next half hour. When Powell speaks to the media, that's when we see the biggest impact on the market. So it's not so much about the numbers that are released, but rather what Powell says in his speeches. This is why in the past live streaming, we covered the Fed's meeting, and when the US media outlets asked questions, and Powell answered them on stage. That's what we need to observe. You can also see that the impact of the FOMC meetings on the market is diminishing. Let us go through them one by one, including the most recent one, which is just a few days ago. It's still fresh in my memory. The price change was 2% at that time, and the one before had a bigger price change, but the predicted and actual interest rates were the same. The last time was a bit more at 7%. Before that, the predicted and actual interest rates were the same. Basically, FOMC rarely deviates from its predictions. The forecast value is basically the same as the actual value. This is 3%. You can see that the amplitude isn't that big. The percentage here is slightly larger. It's slightly more than 3%, which is all right. It's not too high compared to previous ones. Let's go further back. This ratio, it's slightly above 3%. However, going further back, the percentage is much higher. Do you all still remember what happened back then? I still have a vivid memory of it. The price went up first, then down, and then up again. Yes, that's exactly how it went, because I remember it clearly. It was a 6% drop. Let's go further back to July 28th. Wow, the price was really exaggerated. It was a 7% increase. What about earlier than that? It was an 11% price change. So, we can summarize that in the past FOMC meetings, we can conclude that the impact of FOMC on the market has been decreasing. In the past, it could cause a lot of volatility. But now, the impact has become smaller. The fundamentals of the U.S. economy are no longer the market's top concern. In the past, the U.S. fundamentals, FOMC and CPI, were the market's focal points. They deeply influence the market. However, their influence has been slowly diminishing. It's still there, but it's gradually fading away. Now, how do we judge the rise and fall of the market? For FOMC, we mainly look at Powell's speech and how he answers the media's questions. What about the impact of the CPI announcement? Historically, every time it was announced, the market went up. All right, we will still be with you through the ups and downs of the market. Welcome you to join my community, where experienced traders and teachers share their knowledge. We have members who share their insights there too. We welcome you to join us. Also, you're welcome to like and share my videos and subscribe to my channel. Turn on the little bell button to show me your greatest support. Thank you so much. Bye-bye.